Hey there guys, it's Matt Crowley here from Sweet Zone Properties. I'm just really quickly going to go over this economic indicators dashboard. It's available for free download from the site here. I'll just go over how a few things work. So it's dynamically updating. The only part of it, you do actually have to go through and update each one of these spreadsheets. All you got to do is just download it's an Excel app. It's actually just available on Federal Reserve economic data, and you just click update to the spreadsheets. But I'll just take you through what some of these things here mean. So here we are, beginning of 2014. We're looking at ISM manufacturing, the PMI composite index. Basically, we're looking for something above 50. It's basically a subjective measure, but it means manufacturers are actually under the belief that things are going to improve in the economy, so it's what's called a leading indicator, as is this other leading indicator here. And I've scattered in YOY is year over year, month over month is MOM. It just kind of smooths out the trends so that you're not looking at really spot data. There's a bunch of little charts here. We see the biggest activity is actually happening in the 3-month treasury bills, with the yield beginning to increase significantly. Big reason here is US doesn't own a lot of short-term debt anymore, so this is really what we're going to start seeing big changes here in the secondary market, as the US no longer owns a lot of this. Some pretty interesting things. Manufacturing new orders, very cyclical, hard to really see anything. Housing starts, quite a significant upturn here. Some of the big highlights, this one right here, this is our consumer sentiment, huge improvement off of our 24-month low, 50%. That there is a 24-month moving average, so this automatically populates based on what kind of data we have available. And it's a 12-month moving average, so it just kind of eliminates kind of the bias in the data. And so we do see that going up quite a bit, which is important in behavioral economics. Unemployment rate, I'm going to talk about that one a little bit later. Housing starts also up significantly, up almost 60% from the 24-month low. That's super positive. New orders for manufacturing up significantly, as is durable goods, up quite a bit. But if you look at the last date and the last data, I mean, you can kind of figure out if there's any biases in the data. What's really important as well, real GDP, almost really no move. Off of the 10-year low, 10.3%, which is good, but you should be suspicious of what CPI is being reported as. These are extremely interesting. These are broad macroeconomics. This is why you shouldn't be overly optimistic with the U.S. economy. You can see here, there's two axes here, but everything's labeled. So federal debt, total public debt as a percent of GDP, it's 100%. So that's obviously not sustainable. It's going to have some long-term solvency issues with that kind of debt. This is interesting. The VIX here is basically a volatility index. It's supposed to be a future indicator of what the stock market is going to do. It also determines how much derivatives are worth through some kind of complicated formula. But we're seeing a decrease in the VIX, which means that investors as a whole believe that the stock market is becoming less risky. We see this huge depreciation of the Japanese yen. That's due to Abenomics and basically the huge printing of money to try to get Japan out of the long-term recession. Not really surprising here with the pound. They're basically stopping printing money. USD to the euro, that's also exactly what we expect. I don't really expect that to change. So I mentioned in my post there's some weird things going on with the unemployment rate and the labor participation rate. You can see here quite clearly the unemployment rate is falling in the States, which is a good thing. But look at the labor participation rate, plummet. So that's a really suspicious statistic there. Non-farm hires, I mean, it's going up. It's a slight upward trend, but it's hard to really say. Durable goods is a very strong leading indicator because people aren't going to buy expensive things like dishwashers and ovens and that kind of thing, and even vehicles if they don't think that economic conditions are improving. So this is actually a really positive sign. Retail, again, increase in consumer spending, very, very positive. Producer price index, this is a year over year. If you get every single data point, it's really hard to determine if there is any improvement. Year over year is going to smooth out that data. You can see here it's just slightly increasing. The producer price is what producers are willing to pay for their goods. It's actually a good thing. Vehicle sales, yeah, we're seeing slight improvement on that. Check out CPI. Headline inflation, yeah, it says that we're barely experiencing inflation. Yeah, right. This here is probably more interesting. Shelter, here's the dotted blue line. We can see it's pretty much leading in terms of CPI inflation. What this means is it's becoming more and more expensive in the US to be a renter, which is going to lead to some aggressive lending strategies. That one there's a little bit more advanced chart, but that's kind of the high level of this here and how that works. And spreadsheet's available for download. You can change anything you want on it, totally open source. So thanks a lot.